All right, today we're going to get you started on thinking a little bit about what you're going to invest in for the rest of your life. And this class, remember, is just kind of a start to what you're going to be learning. And then after this class is over, you want to explore some of these areas in more detail for yourself to create a financial plan once you leave education. All right, some basic terms that we use in business, and all corporations create these financial statements, and one of the most common ones we always look at is the balance sheet. And the balance sheet, and some of you guys might be looking at this like, man, Navikas, this is kind of boring here, but this is something very important that you need to kind of understand for yourself. If I were to go and if you were to go home and make a list of all the things that you own of value, we call those assets. So assets represent ownerships of value that can be converted into cash. So if we add up all the things that you own of value, savings accounts, checking accounts, some of you guys might have stocks, bonds, jewelry, collectibles, Beanie Babies, whatever the case might be, you come up with a grand total of what those are worth. Then that would equal your liabilities, what you owe, and so basically what you owe, what you own of assets minus what you owe gives you what is basically your net worth, and that's the residual of assets minus liabilities. So we can move the equation around. You guys are good at basic algebra, so if we take out liabilities on this side, it'd be assets minus liabilities equals owner's equity. So the goal of the class is to kind of give you some knowledge on how to build this number, this owner's equity amount, over time. Now here's a problem that many people that don't take business classes, don't take personal finance classes, they make a huge mistake. They buy too many assets that depreciate when they're young versus buying assets that appreciate. To make matters even worse, they purchase these depreciating assets using liabilities. So, big mistake, people graduate college, they go out and they purchase a car. Well, a car is considered an asset. Okay, but when they purchase the car, they borrow money, so they create a liability. And as they pay off that car, the value of the car goes down in value because you start driving around, you use it, and then before you know it, you've purchased an asset using a liability, paying interest on something that's going down in value. Now, we all need cars. Most people need cars for their job, to earn income, unless you live in an urban center where you can take public transportation. But most people in the U.S. purchase cars. So my advice to you is, if you don't have to purchase a car right away when you're young, use the car that you were driving around in college, extend the life of that car, and avoid taking out that big liability. That's the first common mistake. Then people, you've been living with your parents, they've been working for a long time, they have nice furniture, and a lot of people want to replicate that when they're young, and once again, you're buying stuff that furniture's, even though it's considered an asset, it goes down in value. So you want to think a little bit about the things that you're buying. Now, clothing, you want to look nice on the job. A lot of people overspend on electronics, etc. Okay, so really keep that in mind. If you understand this equation and you want your net worth to grow over time, you want to limit your liability exposure right when you start working. So here's a plan for you, and this is a plan that I'm laying out that I would hope my own kids would kind of, maybe take to heart and really consider this particular plan. So year one, you obtain your first job. You graduate college, you obtain your first job. The first thing you want to do is to build an emergency fund. So really the best way to do this, and I'm really aggressive on this, I want you to save 15% of your gross income. So that means before any taxes are taken out, you save 15 cents of every dollar that you earn. And when you think of it that way, a lot of people, well, that doesn't seem like a lot, but really right now Americans on average have a very low savings rate. They're probably saving under 1% of their gross income, and I'm asking you to do 15. But if you follow that rule, you probably won't have to worry about money for a long time, or maybe ever. Okay, so what we want to do is we want to build an emergency fund. Emergency fund is 6 months of living expenses. So if it costs you $2,000 a month to live on your own, you'd want to have a savings of $12,000 somewhere. That way, if you lose your job, something goes down, you have 6 months to live out, to adjust your lifestyle, and that's kind of what the emergency fund is about. Limit your exposure to liabilities. I kind of just talked about that. And then third, stay away from credit card debt. You want to use the credit card every month, but make sure you pay it off because by using it a few times a month and then paying it off, you're establishing a credit history which will make your score go up, and that will be covered in another assignment that you'll have. So you complete year one of work. So now you evaluate your career choice. If you like it, you stick with it. And now you create what are called asset buckets. You want to purchase assets that go up in value. So you have investment one, investment two, investment three. I had a student ask me a question today: do I have to invest in stocks and bonds? Well, the answer is no. You don't have to. There's other investments, real estate, savings accounts. But what you want to do is you want to have, my advice is have a minimum of 3 different types of asset classes. That's a tough phrase there, asset classes to be invested with. So in year one, you start putting a little money into each one of these different investments. Year 3, now you continue adding money to the buckets. And then year 4, you continue evaluating your career choice. You're never, a lot of young kids, they go out, they major in something, they go out and get a job, and they're like, I don't like this, I'm going to change what I'm doing. There's nothing wrong with that. My advice is, hey, do more studying now in high school. Try different classes. See what you're interested in now, so you don't run into that mistake down the line. If you want to become a teacher, go volunteer in a school. Go tutor kids. And if you don't like working with kids, then hey, that's an easy answer. If you want to go work in, the finance industry, see if you could go work at a bank or somewhere local where you could kind of get into that area and see what it's all about, what a business setting is like. If you want to go work in a hospital, go volunteer at a hospital. So we want you to create this career choice. That's why we did that in the first unit. So now, once we have our career and we're happy in our career, we could focus on building these asset buckets over time. And before you know it, bam, we have these asset buckets that are overflowing with value. Now, the person that doesn't study this and doesn't go this route, they're at a huge disadvantage. But because by the time they're 30, 35, then they're like, they finally learn about all this, and they're like, oh, I have to start doing this now. And now they've wasted 10, 15 years of working life where they could have a full bucket by then in some of those areas. All right, so here's the areas that you're going to study. Stocks. You could have a trading account, so you could trade independently. And this takes a higher, more sophisticated knowledge for some people because you're managing money, and some people don't feel comfortable doing that. Most of you are going to have what is called the 401k. The 401k is an employer-sponsored plan. You have to have a job. You have to have earned income. It's tax-deferred income. A Roth IRA is not tax-deferred. You have to set this up on your own. You have to have earned income. There's caps and there's rules for both of these, and I want you to find out those rules for me, and you're going to report back to me those rules. But really, out of all honesty, I think all of you are going to be operating in these two areas, hopefully, as part of your buckets. Mutual funds, it's a collection of stocks. A manager will go out and buy a bunch of stocks based on the objective of the plan. And then a more popular thing now are exchange traded funds, where you could trade you could trade indexes, you could trade commodities and all different types of things using ETFs. But like I said, that ETFs would go along with a trading account, and some people just don't feel comfortable. You probably want to take like an investing class. We have an investing class at DHS that covers how do you run a trading account. We're going to cover the basics of it in this class, but you want to get more information before you start doing that. Bonds. Bonds is when you loan someone money and then you get a stated rate of return for that loan. Life insurance contracts. You have what is called permanent life insurance, and those are policies that you pay indefinitely until you reach the cap of the policy. And so the purpose of the plan is you're going to get a return on part of the premium that you're paying along with a death benefit. Real estate, so you could directly own real estate and rent it out to other people. Options, this is a little more sophisticated. It goes along with stocks. They're called derivatives, and basically they represent an underlying asset. At DHS, we have in our investing class, we spend a whole quarter on option trading. 6 are commodities. Commodities are there's hard and soft commodities. So you have like crops. You have gold, silver. There's oil, all different types of commodities you could trade in. Then real estate indirect, what are called REITs, real estate investment trusts. I'm kind of going through a lot of stuff right now, but I just want to give you an idea of all the different types of buckets you could choose from. small business investor, so you could start your own small business. You could invest in small businesses. You could be a currency trader, and there's many, many other things. Remember, currencies are traded off of one another. So when you turn on the news, they'll tell you the value of the dollar versus the euro. A lot of you guys travel to Europe, and you know there's an exchange rate. Well, that's all depend in the currency markets, and those get traded throughout the world. So there's a lot of different things that you could go on and study. My advice, I want you to pick three. The biggest mistake people make is that they put 90% into four, and then they put 10% of their wealth in here, and they're so unbalanced. And what we just saw, 2007, the housing market collapse, so many people in the U.S. lost tons of money because they were too heavily weighted in the real estate bucket. All right, so that's kind of a start to get you thinking a little bit about this concept. And just to kind of go back, we want to have full buckets. We want to fill these buckets up, and it's a slow process. In the beginning, we don't add a lot into it, but as time marches on, we have the concept of compounding interest and all that other stuff takes place.